It had survived 85 years of Wall Street, the Great Depression, Black Monday, the dot-com crash. Then in 72 hours it was gone. $2 a share. Down from 172. And it was only the beginning. This is Bear Stearns. In March 2008, Bear Stearns was the fifth largest investment bank in America, and it had survived the Great Depression and Black Monday and the savings and loan crisis and the dot-com collapse and 85 years of Wall Street turbulence, and in the space of 72 hours it ceased to exist, and the Federal Reserve organized an emergency rescue over a single weekend, and JP Chase acquired it for $2 a share. A price later raised to $10, compared to a peak share price the previous year of $172. And what happened to Bear Stearns was not just the collapse of one firm, it was the first unmistakable signal that the entire financial system built on mortgage-backed securities was in catastrophic danger, and that 2008 was going to be unlike anything the world had experienced in generations. Bear Stearns was founded in 1923 in New York, and for most of its history it was known as a scrappy, aggressive firm. Not the most prestigious name on Wall Street, but one of the most profitable. A firm that prided itself on its trading culture and its willingness to take risks that more conservative institutions avoided, and by the early 2000s it had become one of the most important players in the mortgage-backed securities market. The market that packaged individual home loans into financial instruments that could be sold to investors around the world. And this was enormously profitable, and Bear Stearns built its balance sheet on these instruments with enthusiasm. In June 2007, before most people outside the financial industry understood what was coming, two Bear Stearns hedge funds that had invested heavily in mortgage-backed securities collapsed and had to be bailed out by the parent company at a cost of approximately $1.6 billion, and these were not small obscure funds. They were funds that Bear Stearns had marketed aggressively to clients as safe investments, and their collapse was the first major visible sign that the subprime mortgage market, which underpinned all of these instruments, was in serious trouble, and Bear Stearns spent the rest of 2007 in a state of increasing stress as the mortgage market deteriorated and its own holdings of mortgage-backed securities lost value and its funding costs rose. The real crisis for Bear Stearns was not about the value of its assets. It was about funding, and like all investment banks, Bear Stearns relied on short-term borrowing, overnight and weekly loans from counterparties in what was called the repo market, to fund its large balance sheet of long-term assets, and as long as counterparties trusted Bear Stearns, they would renew these loans every day or every week and the machine would keep running. But if counterparties lost confidence, if they stopped rolling over the short-term loans, Bear Stearns would find itself with billions in assets it could not sell quickly enough to repay the funding it owed, and this is exactly what happened in March 2008. Rumors about Bear Stearns' financial health began circulating in the first week of March 2008. Some of them accurate, some of them exaggerated, and in the world of financial markets rumors about solvency are self-fulfilling. When counterparties hear a firm may be in trouble, they stop lending to it, which then puts it in trouble, and this is what began happening to Bear Stearns. Counterparties started pulling their repo funding, hedge funds started withdrawing their prime brokerage balances, the cash that Bear Stearns needed to operate began draining away at terrifying speed. On March 13, 2008, a Thursday, Bear Stearns' CEO Alan Schwartz was on television telling the world the firm was fine, and by Friday morning it was not fine, and the board was informed that Bear Stearns had approximately $2 billion in liquidity remaining, down from over $18 billion just days before. And $2 billion was not enough to open on Monday, and the Federal Reserve and the Treasury Department were immediately brought in, and the conclusion reached over that weekend was that Bear Stearns could not be allowed to fail in a disorderly way, that the consequences for the entire financial system of a chaotic bankruptcy of a firm with hundreds of billions in derivatives exposure would be too severe. And JP Chase, which was Bear Stearns' clearing bank, agreed to acquire it with financial support from the Federal Reserve. The acquisition price of $2 per share was announced on Sunday, March 16, 2008, and the reaction on Wall Street was shock, not just at the price, but at what it signaled. Because if Bear Stearns, which had seemed like one of the more resilient firms on the street, could collapse in 72 hours, then the question immediately was, who was next? And the answer, though nobody said it out loud that Sunday, was that the entire architecture of the financial system was at risk. Jimmy Kane, the long-serving CEO of Bear Stearns, who had built the firm over decades and who had controversially been playing bridge at a tournament during one of the critical weeks of the hedge fund crisis the previous year, had already been replaced as CEO by Alan Schwartz in January 2008, but remained as chairman, and the firm he had built was gone, and the shareholders who had owned it, including Bear Stearns employees who had much of their net worth in company stock, lost the vast majority of their investment, and the collapse of Bear Stearns prefigured by 6 months the collapse of Lehman Brothers, which was larger and more catastrophic but followed exactly the same pattern. a confidence crisis, a funding crisis, a desperate weekend, and an ending. So what is the real lesson of Bear Stearns? And the lesson is about the fragility of confidence in financial institutions and about how quickly a firm that appears solid can find itself unable to fund its operations when trust evaporates. And Bear Stearns teaches that in modern financial markets, where investment banks fund themselves with overnight borrowing, confidence is not just important, it is the asset, and when it goes, everything goes. And the specific lesson about Bear Stearns is also that the Federal Reserve's decision to rescue it, to arrange a buyer with government financial support, may have sent a signal to the market that the next firm to face a similar crisis, Lehman Brothers, would also be rescued, and when that rescue did not come, the shock to the system was exponentially more severe than if Lehman had been allowed to fail in an orderly way earlier. And the decision of whether to rescue Bear Stearns and what message that sent about future rescues remains one of the most debated decisions in the history of financial crisis management. That is the capital case. Subscribe to the capital case because the next case is already waiting.